Hello friends, hope you have an amazing day and welcome to my new blog. Today we discuss about the capital structure of an organization or a company. So the term capital structure refers to the proportion between the various long-term sources of finance in the total capital of the firm. The major resource or sources of long-term finance include proprietors funds and borrowed funds. So capital structure is the makeup of a firm's capitalizations. That is, it represents the mix of different sources of long-term funds in the total capitalizations of the company. So the capital structure represents the only long-term funds, that is long-term debts, shareholders equity, etc., and excludes all short-term loans and advances. So the selection of an appropriate capital structure is a very crucial decision and depends on a number of factors such as the nature of the company's business, the risks involving the requirements of the government, regularity of earning conditions of the money market and the terms that prevails in the industry and the attitude of the investor, etc. Now, capital structure is the permanent financing of the firm represented primarily by the long term debts, preferred stock, and common equity also, but including all short term credit. Common equity includes common stock, capital surplus, and accumulated earning also. The firm's strictly financial point of view, the optimum capital structure is achieved by balancing the financing as to achieve the lowest average cost of long term funds. So this in turn produces the maximum market value of the total securities issues against a given amount of corporate finance. So we can thus define capital structure as the overall mix of components of capitalizations. Now we discuss about in details what is capital structure, its meaning, definition, features, significance of capital structure, patterns of capital structure, principles, tools, optimal capital structures, decisions, theories, distinctions of capital structure. Now, what is the meaning of capital structure? First of all, we discuss about this. Since the finance manager is responsible to procure 10 required funds for a firm from different sources, he has to select a finance mix or capital structure which maximizes shareholders' wealth. For designing the optimum capital structure, he is required to select such as a mix of sources of finance so that overall cost of capital is minimum. So capital structure refers to the mix of sources from which the long-term funds required by a business are raised. So capital structure decision is concerned with the sources of long-term funds such as debts, equity, capital. Capital structure is defined as the mix of various long-term sources of funds, broadly classified as debts and equity. Hence, capital structure is also referred to as debts equity mix of a company. Now, in other words, capital structure represents the proportional relationship between the debts and the equity in the total capitalization of the company. So, equity capital includes paid off share capital, share premium, reserve, and surplus, that is retained earning also, while debts capital includes bonds, loans, debenture, etc. For the purpose of the capital structure preference, shares are also classified in the category of debt capital. So this is because preference share also bear a mixed rate of dividend and they are generally redeemable. So hence capital structure of a company is the composition of debts and equity capital in total capitalization of the company. So debt and equity capital differs in terms of cost and risk also. From the viewpoint of the company raising funds, debt is considered to be a cheaper source than equity capital. However, debt also increases the finance risks of the company and may be responsible for increase in cost of equity also. So capital structure decisions in terms affects the overall cost of capital of a company. This overall cost of capital is generally used as discount rate while evaluating capital projects under capital budgeting decision also. The term capital structure refers to the proportion between the various long-term sources of finance in the total capital of the firm. The major sources of long-term finance include proprietors funds and borrowed funds also. So proprietors funds include equity capital and preferred capital, reverse and surpluses, that is retained earning, and borrowed funds include long-term debts such as loans from financial institutions, debenture, etc. In the capital structure decisions, it is determined as to what should be the proportions of each of the above sources of finance in the total capital of the firms. In other words, how much finance is to be raised from each of these sources. These sources differs from each other in terms of risks and their cost of enterprises. Some sources are less costly but more risky, whereas others are more costly but less risky in the organizations. Capital structure refers to the mix of sources where the long-term funds required in a firm may be raised, that is, what should be proportions of equity share capital. So preference shares capital, internal sources and debenture and other sources of funds in the total amount of the capital which a firm may raise for establishing its business also. So capital structure is the makeup of a firm's capitalizations, that is, it represents the mix of different sources of long-term funds in the total capitalizations of the company. Now capital structure represents only long-term funds, that is long-term debts, shareholders equity, etc., and excludes all short-term loans and advances also. So the selection of an appropriate capital structure is a very crucial decision, and selection of an appropriate capital structure is a very crucial decision and depends on a number of factors such as the nature of the company's businesses. The risk involves the requirements of the government regulatory of earning conditions of money market and the terms that prevails in the industry and the attitude of the investor, etc. Now capital structure, the definition, what is the definition of capital structure? Now we discuss about in details. The terms capital structure has been defined by several authors differently. So capital structure refers to the composition of long-term sources of some funds such as debenture, long-term debts, preference shares capitals and ordinary capital share capitals, including reserves and surpluses, retained earning that I mentioned earlier. Now, capital structure is the permanent financial of the firms represented primarily by the long-term debts, preferred stocks and common equity, but excluding all short-term credit. Common equity includes common stock, capital surplus and accumulated earning also. Now, the term capital structure is frequently used to indicate the long-term sources of funds employed in a business's enterprises also. Now, the form from a strictly financial point of view, the optimal capital structure is achieved by balancing the financing so as to achieve the lowest average cost of long-term funds. This in turn produces the maximum market value of the total securities issues against a given amount of corporate finance. We can thus define capital structure as the overall mix of components of the capitalizations. Now, capital structure, it allows maximum possible uses of leverages. It involves minimum possible risks of loss and control in organization. It helps to avoid undue restrictions in agreement of debts. It helps and avoid undue financial risks with the increase of debts. it takes care that the use of the debts is within the capacity of a firm. The firm should be in position to meet its obligations in paying the loan and interest charges as and when they fall due. Now, features of an appropriate capital structure. So, an appropriate capital structure should attempt to establish the mix of securities in such a way as to raise the requisite funds as the lowest possible cost, as the cost of various sources of capital is not equal in all circumstances. It should be ascertained on the basis of weighted average cost of capital also. The management should aim at keeping the issue expenses and fixed annual payments of at the minimum in order to maximize the return to equity shareholders also. And an appropriate capital structure should be devised in such a way as to maximize the profit of the firm. So, in order to maximize the profit, the firm should follow a proper policy of trading on equity so as to minimize the cost of the capital. An appropriate capital structure should possess the quality of minimum risks. So, risks such as increase in taxes, rates of interest, cost, etc., and decreases in prices and values of shares, as well as nature calamities, adversity, and adversely affects the firm's earning. Therefore, the capital structure should be devised in such a way as to enable it to afford the burden of these risks easily. Now, maximize control. An appropriate capital structure has also the quality of retaining control of the existing equity shareholders on the affairs of the firms. Generally, the ultimate control of the firm rests with the equity shareholders who have the right to elect directors, and thus, while determining the issue of the securities, the question of controlling management should be given due considerations. In case of the firms issues a largely number of the equity shares, the existing shareholders may not be able to retain control. The firm should therefore issue preference shares or debentures to the public instead of equity shares, because preference share carry limited voting rights and debentures do not have any voting rights. That's the difference between the two. And thus the capital structure of the firm should not be changed in such a way which should adversely affect the voting structure of the existing shareholders, so dilute their control in the firm's affair. So, about the flexibility of the capital structure, and appropriate capital structure should have the quality of flexibility in it. A flexible capital structure enables the firms to make the necessary changes in it accordance to the changing conditions. In other words, under flexible capital structure, a firm can procure more capital whenever required or redeem the surplus capital. A appropriate capital structure has to maintain proper liquidity which is essential for the solvency of the firm. In order to achieve proper liquidity, all debts which threaten the solvency of the firms should be avoided, and a proper balance between the fixed assets and the current assets should be maintained accordance to the nature and size of the businesses also. A firm has to allow the policy of conservatives or conservatism in divisions of capital structures. Thus, this would help in maintaining the debts capacity of the firm even in unfavorable circumstances also. An appropriate capital structure is needed for optimizing utilizations of financing or financial resources of a firm, both under capitalisms. Over capitalisms are injurious to the financial interest of the firm. So thus there should be a proper coordinations between the optimum of capital and the financial need of the firm. A fair capitalization enables a firm to make full utilizations of the available capital at minimum cost. So, an appropriate capital structure should attempt to secure a balanced leverage by issuing both types of securities, that is ownership securities and coordinator coordinatorship securities. Generally, shares are issued when the rate of capitalization is high. So the debenture are issued when rate of interest is low. So thanks. That's for the video, my friends. In the next episode, we are discussing the simplicity about the capitalisms. Our thanks a lot for watching my videos. If you like my videos, please share, subscribe my videos. Thanks a lot for watching.